Good morning. Welcome back. Hope you're feeling well. Let's get back to macroeconomics. So we're talking about the business cycle. We're talking about the business cycle and analyzing it through the lens of the aggregate demand and aggregate supply framework. We talked first of all about the business cycle when it's driven by demand shocks. And then on Monday, we talked about the business cycle when it's driven by supply shocks. What we have yet to do before our midterm on Monday is to talk about what is the appropriate policy response of the Fed when there are supply shocks. So that's what we're going to do today. First, I'll start with a little bit of review of what it is that the Fed should do in the face of demand shocks, and then that'll give us a context where we can then introduce supply shocks and see what's different. So, to do that, so I guess our topic is stabilization policy. And the question we're trying to address is, what should the Fed do? And before, I guess, talking about business cycles and what the Fed should do, I think it's worth pausing and thinking a little bit briefly about what the Fed actually does do. So it turns out that in the documents that created the Fed, and which I guess means, I think by law, the Fed is in fact supposed to pursue two very specific goals. One is often referred to as price stability, which I guess means two things. One, we don't want the price level jumping around too much. That's obviously one interpretation of price stability. Another interpretation of price stability is, well, what do we call the periods when prices are most unstable are going to be periods of high inflation. So price stability means both literally we don't want prices jumping around because obviously that creates uncertainty for everyone. It also means we don't want very high inflation. Okay? And the second goal that the Fed has is, I guess broadly speaking, avoid high unemployment. Okay, and these two things together are known as the Fed's dual mandate. Right? The two things that it's supposed to worry about. Price stability, which also implies low inflation, and avoiding high unemployment, which I guess we could interpret as avoiding recessions. Okay. So with this in mind as the Fed's goal, now let's see what our aggregate demand and aggregate supply framework has to say about this. So let's suppose we're starting off in long-run equilibrium. There's potential GDP. And as I said, for review, let's suppose that there is, first of all, some sort of demand-side shock, and let's suppose that it is something that leads to a recessionary gap, as pictured here. So then we would have gone from this price level to this one, and simultaneously we have the opening of a recessionary gap. So, in the face of this situation, what is the Fed supposed to do? Well, let's see what the Fed is supposed to do from the perspective of price stability. What do we want to do to stabilize prices and push them back where they would have been before? Well, we would want to, well, first of all, I guess we have to take a step back and remember what are the tools that the Fed has to try and achieve either of these goals. The tools the Fed has are that the Fed can have some power over interest rates, and the Fed has some power over the supply of credit. And of course, both of those things show up here because the supply of credit and interest rates are things that affect aggregate demand, because they ultimately affect spending. So, that means that what the Fed has to do in response to these changes is to try and move aggregate demand one way or the other. If the Fed wants to stabilize prices and get them back where they wanted, what does it need to do? It needs to push the demand curve this way, which means the Fed should, let's see, what color am I going to do? According to this goal, the Fed should boost spending, which means that they want to make interest rates lower or increase the supply of credit. Of course, as we discussed, doing one of these does the other one as well, because of course the only way the Fed lowers rates is precisely by buying up some asset or making loans. Either way, they're boosting the supply of credit. And that would push us back in this direction. Right? What if instead the Fed's goal is to try and avoid high unemployment? What should it do then? Well, to try and lower unemployment, we would want to close this recessionary gap. But looking at the demand curve, we see that if we want to close the recessionary gap, well, we would be doing the exact same thing. We would also want to be boosting spending by lowering rates and boosting credit. So, to conclude, when we have demand shocks, there is no tension between these two goals of the Fed. The Fed trying to stabilize prices or the Fed trying to fight recessionary gaps. Either way, it leads us to conclude that the Fed should lower rates / boost credit. So these goals end up being consistent with each other in this case. Okay. And that's the case that we've looked at so far. Any questions, comments about what the Fed should do in the face of demand shocks? All right. Now, let's erase all this and go through that discussion again, but for the case of supply shocks. So let's first of all remember what supply shocks are. And so the idea is that sometimes, even if it's not that often, it could be that there is something that moves the supply curve that leads us out of long-run equilibrium. And all of these examples that we came up with, ultimately, you could think of as being a shock that increases the cost of doing business significantly. So what were the examples that we looked at? The classic cost shock that everyone thinks about. I guess the first thing that comes to mind when people think about supply shocks tends to be big changes in the price of oil or the price of energy more broadly. Second, we discussed that when we were thinking about, well, why was there high inflation in the 70s, one of the things that some economists proposed was that there were increases in the intensity of regulation there, specifically to do with the regulation of energy markets, as it happens. But in general, you can imagine that any large change in regulation might increase the cost of doing business, which might show up as a supply shock, at least temporarily. Third, we thought about the fact that the most important input price here, the most important determinant of costs, is the cost of labor. So in principle, anything that has a big impact on the cost of labor is going to give you a supply shock. And we spent some time discussing the idea that a key determinant of the cost of labor is this. The forecasts that everyone makes about future inflation. And why is that so? Well, again, as a reminder, in a period where we expect there to be high inflation, a given wage isn't going to actually be worth that much in terms of final goods and services, which means that if I'm negotiating with my boss, I'm going to want them to compensate me, at least in part, for this high inflation we expect, and they may also feel pressure to pay me more because they know if they don't, I'm more likely to go somewhere else. So in a period where inflation is expected to be high, that puts pressure on wages, which may move the supply curve. And that description, that sequence, may give you some sort of feeling that reminds you a little bit of animal spirits, right? In the sense that we have a situation where if people expect a thing, their behavior in response to that thing actually makes it happen. So there is an element of that where it comes to inflation. If people think there's going to be a lot of inflation, it puts upward pressure on wages, and that's a supply shock, and it might actually cause inflation. So keep that in the back of your minds because it's going to come up again. I hope you're not going to drink all of those at once. That won't be very good for your health. So finally, there was one more possible source of supply shocks that we considered that might be relevant for our current predicament, and that's what I called supply chain fragility. And that was the idea that in a situation where we were, where suddenly, we started off in a situation where the production of many final goods and services depended on parts that were sourced from all sorts of different parts of the world. And then we can think of that whole structure as what's called the supply chain, because there are various links between companies and countries that need to function smoothly in order to result in production of final goods and services, and that these supply chains were interrupted by COVID in various ways. And so there were random shortages of certain things. For example, I remember when was it? I think it was 2021, and my computer stopped functioning, and so I needed to buy a new laptop. And so, as I do every few years, I went on Lenovo's website to buy a new Lenovo, and what you see there is usually there's a standard, well, they have different standard, computers. And then when you click on one of them, it then gives you options, then you customize it, order it, and it arrives in a week. So when I went to Lenovo's website in 2021, there were the standard versions. And then if you clicked to customize rather, it would say delivered in 4+ months. What does that mean? It means they're not making any promises about when they're going to send you that thing if you don't order a standard pre-built version. Why? There were no semiconductors. The world had kind of run out of microchips. And obviously that would affect the supply of computers, but it also ended up affecting all sorts of other goods. So you may remember that suddenly cars started to become extremely expensive. And there was a period when even used cars, like random Toyotas and Hondas, were trading for $100,000. Why? Because there were no new cars, because of certain kinds, because they didn't have the semiconductors that they needed. Car factories were even sort of building cars up to the point where the chips had to go in, and then they would just stop them and leave them in a warehouse. So that's what I mean by supply chain fragility. And in our case, that was not in the 70s, but in our case, that's one of the things that, of course, contributed to our current high inflation. So when any of those things increase costs, how does that show up here? That's what we discussed on Monday. Increased cost means your supply curve shifts to the left or up. And so you end up in a situation like this, where you have a recessionary gap at the same time that you have rising inflation. So that is a supply shock, a negative supply shock as represented in this picture. The question is, given that this has happened, what should the Fed do? Well, first of all, let's see what the Fed should do if they want to pursue this goal, the price stability goal. So the Fed wants to pursue price stability. What does it need to do here? It needs to get the price level down here. It needs to fight the inflation. Right? So again, remember, however, that the Fed can't control the supply curve. The Fed controls interest rates and the supply of credit, and those are both demand-side things. So what the Fed would need to do is, given this new supply curve, it would have to move the demand curve so that we have an equilibrium price level that's down here, right? That's what it means to fight the inflation. And that spot would, of course, be there. So if the Fed wants to pursue price stability, they need to discourage spending, which means they need to raise interest rates or reduce the supply of credit. And again, these two things go hand in hand. But if the Fed does that, sure, we quote unquote stabilize prices, but what else did we do? We just made the recession worse. You could even say the Fed is responsible for this recession, right? This part maybe was a supply shock, but this is something that, in this case, the Fed would have consciously decided to do. That's going to be popular. I mean that, okay, I'm being sarcastic, but I do mean literally that a move like that would be unpopular. a move like that might be, let's say, a dark mark on your legacy. Let me show you very briefly a history of inflation over the past few decades. And you can see here is the 60s. Here inflation is going up throughout the 70s and up. It hits 11% and then up again. In 1980 it reaches an extraordinary 13.5%. And then it comes down. Why does it come down? Look at what interest rates do around that time. These are really high interest rates. So whoever was running the Fed at the time decided that they were going to raise the rates as far as possible precisely to try and kill that inflation. That person did two things, right? They were first of all trying to fight the inflation, but second, they knew that doing so would be at the cost of a very large recession that they themselves caused. That person is called Paul Volcker, passed away not too long ago. And that recession from the very early 1980s that he, or I guess the Fed, under his leadership, basically caused is known as the Volcker recession. Do you want to have a recession named after you? Probably not. Oh, you do? I had two friends who played pool against each other, and they had a wager. And the one was a philosopher and the other one was a biologist. So one said, if I win, I will dedicate my first book to you. If you win, you have to name the first virus you discover after me. Anyhow, so this looks like a hard thing to do. It certainly looks like an unpopular thing to do. So what if instead you decided, I'm not going to try and stabilize inflation. Instead, what I'm going to do is I'm going to fight the unemployment. So let's clean this up. Bring us back to the point where we are experiencing the supply shock and the Fed has yet to act. And they decide, maybe they go through this thought process and say, you know what, I could raise rates to fight the inflation, but that's going to make life much harder for people and is going to tarnish my legacy. So what if instead I try to avoid high unemployment? What should I do then? Well, if I want to avoid high unemployment, I'm stuck with this supply curve, so I have to move, again, the demand curve, because that's all the Fed can move, to some point on the new supply curve where this recessionary gap has closed. And of course, that's this point here. So in other words, if I'm going to instead fight the unemployment, I have to do this. And if I do that, what do I see here? I made the inflation worse. So in that case, I would have acted so as to boost spending. So I'm doing the opposite. I'm lowering rates or extending credit. And in so doing, I might be able to close this recessionary gap, but I also just made the inflation worse. And you might say, well, so what? Recessionary gaps are maybe more painful than inflation, but the question is, what would happen if the Fed actually did this down the road? And for this discussion, we have to come back and look at this list of things that might cause supply shocks and zoom in on one of these factors in particular. If the Fed actually did this, and in the face of supply shocks, showed the world that they would rather fight the recession even at the cost of creating further inflation, what should this do to our forecasts of what inflation is going to look like going forward? It should make it go up, right? We've seen that when faced with the choice of fighting unemployment and fighting inflation, as far as inflation is concerned, the Fed just backs off and will even create extra inflation so as not to annoy all the people who don't like recessions, who might suffer in the recession, of course. So reasonably, after seeing the Fed act in this manner, we should all say, oh, okay, the Fed isn't serious about fighting inflation, so naturally we should expect higher inflation. And of course, what does that do? It means there'll be another supply shock. Once the wages, so whatever it was that started this process, which could have been any of these things, once the Fed acts in this fashion, that should move the supply curve out even further, which, again, with this Fed in office would mean what? The Fed would do it again, which would then raise our expectations of inflation even further. And so the problem is that if the Fed doesn't show that it's serious about fighting inflation right at the beginning, when it started, it may set off this, I guess you could call it, inflationary spiral, where their acts just reinforce our belief that inflation is going to be high, which raises wages, which then also raises inflation, confirming the belief, and so on. This is discussed in chapter 14, and it's referred to in the textbook as cost push inflation. But a key element of it being a process of inflation, as opposed to just a jump in prices that then stops, is this idea of once we've observed a lot of inflation, it feeds into our expectations, and that just pushes the supply curve further. Yes?
So whatever the Fed does, it would make the other one worse.
Yep. Supply shocks just put them in this problem, in this position where, right, they either have to, they can only target one of the things that they care about, and if they target one, they're making the other one worse.
There is no middle way.
The middle way, I guess, would be to do nothing and hope it goes away. And I guess maybe that's a good point at which to, well, I guess do two things. Whenever we're discussing supply shocks, we end up, first of all, seeing what does this tell us happened in the 70s, and the second thing we do is what does it tell us about what's going on now? So we end at 1225, right? So, okay. So as far as the 70s is concerned, you just saw the inflation numbers, right? They slowly crawl up and up and up and up and up until in like 1980 the interest rates go to 20% and then it ends. So what's the history of this? The history of this was that once the inflationary process started, the Fed was mainly doing something that looked more like this. And so that fed the inflationary spiral until at some point, Paul Volcker comes in and does this and ends it. So that wasn't a very long history, but that's pretty much what it looks like. Right? Yes, sorry.
Couldn't you pretty much do one, and then if it goes too far, do the other to temper it, or is that?
So I think maybe, do I want to show you this? Do you see the Fed funds rate here? So it's pretty low, even while inflation is rising, and then you see it shoot up here to 17%. But then it drops. And then it shoots up again. What happened? Paul Volcker comes in, starts to raise the rates. The economic turmoil is immense, so he backs off. And then he says, no, you know what, we got to get this over with. So they did try it. It did sort of have a big negative effect for lots of people. And then they said, you know what, we just have to do this. Because if not, well, inflation continues to spiral out of control. What are they doing now? Well, when inflation first started to pop up in random places like microchips and cars and so on, and then at some point food. I remember, I think it was January 22, when the Omicron wave was working its way through the population, and there was, I don't know if you remember, there were shortages of food in grocery stores in some parts of the country because like a quarter of the truckers were in quarantine. The goods just couldn't be transported around the country. It was quite a mess. So that's, I guess, probably the moment where inflation most, and shortages, supply chain fragility most, became vivid to people. What did the Fed do and say? Bless you. Nothing. They just said, it's transitory. It'll go away. It's just a one-off. What were they doing? Well, there are two possibilities. One is they really believed that. But what's the other possibility? They're trying to manage our expectations. If we believe them and think it's temporary, then it won't feed into our expected inflation. And then we may have a negative supply shock, but it goes away, as opposed to once it starts to feed into our expectations, starting this inflationary spiral. So the first thing they did was try and keep us calm, basically. And what are they doing now? Now they are raising rates. So let's see. Let's have a look at the interest rates again. So here are the interest rates. As we were discussing, the rates were near zero for a long time because of the financial crisis. Then COVID came, they went back to zero, and now they're up here. What's the interest rate? 4 and a bit. So they're raising the rates. But what's the inflation? About the same. Why does this matter? It matters because of the following. There are two kinds of interest rates. And I haven't been very careful about distinguishing between them, but now we want to be careful about the distinction. One interest rate, which is the one I'm usually been talking about, is defined as follows. You lend me $100, I pay you back $100 plus a bit. That bit is interest, And the interest rate is how big is that per dollar that you lent me. So if you lend me $100 and I pay you back 110, the interest rate is 10%. So that is interest measured in terms of dollars, and anything measured in terms of dollars we call nominal. As opposed to what? As opposed to things measured in terms of final goods and services. Or alternatively, in terms of things adjusted for inflation. And the problem is, if you lend me $100, I pay you back 110, I may be paying you back 10% more dollars, but I'm not paying you back necessarily 10% more in terms of goods and services, because what if there was inflation between you giving me the money and me paying it back to you? Then the inflation I pay back to you, the money I pay back to you isn't worth as much. It's certainly not worth 10% more than what I gave you. And for that, we have the real interest rate, which we can define as the nominal interest rate adjusted for any inflation that might have happened between when you lent me the money and when I paid it back. And I'm going to use the typical macroeconomics notation. For some reason, in all the textbooks, the inflation rate is indicated by the Greek letter pi. I don't know why. Actually, I think I do. It's because it's the growth rate of the price level, and we like to use Greek letters to represent growth rates. All right? So, if the Fed wants to raise rates to attack inflation, which is what they appear to be doing, the rate that they need to raise, because it's the rate that actually matters for our behavior, is the real rate, right? What's the real rate right now? We just saw. The nominal rate is about 4.6, and we also saw the inflation rate, at least the official inflation rate, is around 4.6. What's the real interest rate? 0. Has the Fed raised rates? No, it hasn't. Or at least not enough. Like, if they really wanted to attack the inflation in this way, they would need to raise the raise the nominal rate so much that it's exceeding the inflation rate. Remember when we saw what Volcker did in the 80s? You remember the peak inflation rate was, I think, was it 14? Yep. The peak interest rate was 19. But that's exactly the point. It was higher, right? By quite a bit. And we saw that it had the effect of creating the Volcker recession. That's not what the Fed's doing now. If you think about the fact that, given that there's inflation, and given that nominal rates are up to 4, are about the same as the inflation rate, that means the real rate is 0, that means they haven't fought. That means they're really actually doing this. A little. Real rates shouldn't be 0. If the real rate were 0 on average, no one would ever lend to anyone. Yeah?
So out of the two versions of options, the Fed is just not doing anything now?
So I guess, in a way, well, remember, a real rate of 0 is, so to speak, lower than average, right? Because if the average real rate were 0, as I said, no one would ever lend to each other. Because the average real rate, let's just say, it's a small number, especially if it's on something very safe like government bonds, which is, I guess, what we're talking about. But, so let's say 2 or 3%, but it shouldn't be 0 on average. Actually, if you look at at what happened in the 70s. When inflation starts climbing, the interest rates don't. And indeed, what you have is that for the entire decade of the 70s, basically, you have negative real rates. Which means that whatever the Fed was doing, they were implicitly doing this. They certainly weren't doing what you would need to do to kill the inflation. And as I was saying earlier, that's kind of understandable. If you're going to do this, your name will go down in infamy, right? You'll be known as the person who created a recession out of nowhere. And of course, the reason is because they're trying to stop the inflationary spiral, but it's still not going to endear you to anyone. So there's a quandary there. Any questions, comments, or thoughts about this tension? So to sum up, what did the Fed do? Well, there were supply shocks and inflation did start to appear. They said they were temporary, either because they thought they were or because they were hoping we wouldn't get to this stage where inflationary expectations start to change and start to make the supply curve situation even worse. We are probably now entering that stage, and the Fed is fighting it by raising rates, but in reality they have to raise rates higher than the inflation rate, and they're not. Why aren't they? Well, one possibility again is because they're afraid of becoming too unpopular if they make us drink the bitter medicine. But there is another reason. And to think about this other reason, you're going to need to think not about, I guess I'm talking about the red line, so maybe I should put it up on the board again. To think about why the Fed might not be raising rates as much as you might think they would need to based on this discussion in order to fight the inflation, which would do this and exacerbate the recession. So to understand the Fed's quandary, we need to think not just about the real effect of raising rates. This is the real effect of raising rates, right? You lower the inflation and you make the recessionary gap worse. But rather the financial impact of raising rates. So what is raising interest rates going to do, not in the real economy, but in financial markets? To answer that, remember that our window into what happens in financial markets is largely, or has largely been, balance sheets. So I want you to think back to around the time of our first midterm and think about what a sharp increase in interest rates is going to do to a balance sheet. You haven't seen this material in a while, so again, this is review. You remember the balance sheet keeps track of two things. One is liabilities, which is the sources of the funds that the financial institution manages. The second is assets, which tracks in what form are they right now. If this is a bank, then the main liabilities are deposits, but they're also borrowings. And then, crucially, there is bank capital, which remember is money that is left over for the owners. That's a bit better. In what form do banks hold their funds? Well, again, to some extent, they may hold reserves, and the rest they are making either loans or holding securities. And what kinds of securities do banks like to hold? Bonds, right? There's some mortgage-backed securities and other things, but a big chunk of them are there in the form of bonds because they're highly liquid, and so it's a good way of storing value, as opposed to cash, which doesn't pay you much, right? And now, along comes the Fed. Well, first of all, we get some inflation, and then along comes the Fed and decides we're going to raise rates. In fact, we want to raise the rates so much that we are raising the real rate. In other words, whatever the inflation is, we have to raise rates up to that much, and ideally even more, if we're serious about price stability. What is that going to do here? Yeah. It's going to decrease the value of the securities because, again, higher interest rates is the same thing as asset prices, or in particular bond prices, going down. So this number here isn't going to be 60 anymore. How about we make it, well, we have to make it something smaller. Just as an example, let's say the higher interest rates have eroded the value of my bonds and it's gone down to, let's say, 49. Then this isn't 120, it's 109. Something has to change here. Have the deposits gone anywhere? No. The bank still owes their depositors. Have the borrowings gone anywhere? No. The bank still has to pay back those loans to whoever lent to them. So what do we have? The only way this adds up is if this is -1. So what do we have here? We have an insolvent bank. But we don't just have an insolvent bank, because all the banks are in this predicament, right? All of them are holding large amounts of securities. And in fact, because you'll remember the Fed basically quadrupled the monetary base since 2008, and then doubled it again over COVID. So the banks are holding vast amounts of assets on their balance sheets. And now suddenly the Fed raises rates. It's making them, there's a serious risk of them all getting insolvent. And so if the Fed raises rates too much, there could be a banking crisis. Yes?
Why don't they return their borrowings and then only remove one from their
Why don't they what, sorry?
Why wouldn't they return their borrowings?
So if you pay off these loans, you have to pay them off with something, so you would have to deplete your reserves or sell some securities, and so the only way you can plug this hole is if someone bails you out. Like, let's say if the owner of the bank said, you know what, I'm going to suck this up, I'm going to give the bank another $10 million, and I know that $1 million is just going nowhere. So remember Silicon Valley Bank? The way that went wrong, the way that started to go wrong, is that the bank was trying to raise capital from investors, and they just couldn't get anyone to agree. No one showed up. So, because they knew the bank is insolvent. If the bank is insolvent, if I give them money, what am I doing? I'm just throwing money away. So that's the beginning of their failure. Then everyone could see that they were insolvent because they failed to raise capital, and then that was the end of that. There was a bank run, and they got shut down. So, all right, what is going on in the banks right now? We did see that there were a couple of bank runs, Silicon Valley, Signature, and I think one other. But we're not seeing all the banks go bust, are we? We know all the banks have this exposure to the bond market, so what's going on? Well, two things are going on. One is that the regulations regarding how you account for stuff on your balance sheet actually allow the banks to pretend that some of them that there's still 60 here. How do they do that? Well, in a sense, the details don't really matter, but the way it's done is that a bond is, let's say, a contract that says the government will pay me $100,000 in 3 years. That promise is not worth $100,000, right? Because when I bought that thing, or when I buy that thing, I need to be repaid plus interest. So the promise is actually worth less than $100,000, since I have to wait 3 years. But to some extent, the banks are allowed to count them on their balance sheets as though they were worth $100,000, or to put it another way, at face value. So in these numbers, the securities, if they were sold, would only be worth 49, but if I don't sell them, I'm allowed to pretend that they're worth 60 on my balance sheet. So in reality, the bank might be insolvent, but no one can see it. And what would be the purpose of papering over insolvency in that way? Well, remember that we're imagining that these bonds will be paid off in 3 years. If we make it there without any further problems, then the banks will get $100,000, right? So what this is doing is buying time so that those bonds start to expire, the payments get to be made, and then this insolvency problem maybe goes away. Hopefully. What else has the Fed done? Well, remember that is papering over the problem, right? If for some reason this bank, something happens to the bank and it actually needs cash quickly, then it would have to sell some of these things, right? And then the insolvency would become real. And then there would be no pretense about the state of this bank's balance sheet. So if you're the Fed, you might think, well, I can't just pretend that the $60 million in bonds are there. I need to actually do something more to make sure that these banks aren't vulnerable to any additional shocks. And so what they did is they created a new facility where if you're a bank and you need reserves, you can get reserves in exchange for securities. And if you use this facility, then these securities are valued at face value. In other words, I could, if I'm this bank, I could go to the Fed and say, here's 60 in securities, which are actually worth 49, and they'll say, okay, here's 60 in reserves. So the fact that they're even doing that is concerning, again, right? It suggests that what I just drew on the board is what's going on, or is close to what's going on. Yeah?
Does that mean all the banks are just selling securities now?
Well, they don't want to sell securities because if they did, they'd have to actually incur the losses.
But they are making a profit.
Making a profit.
I mean, if it's the real value of the securities now is 49, then if they sell it at face value,
Well, they're not right. They're selling them to the Fed at face value, I guess, right? Or alternatively, what they're doing is they're lending the securities to the Fed in exchange for 100 in reserves, and then at some point they could, if they no longer need the reserves, or if the securities are expiring, they could switch back. But it's the same thing, right? I think you can tell. It's the same thing as if they just sold them to the Fed at an inflated price. The only difference, I guess, is there's some commitment to take them back later. But once the 3 years are up and it's time for the government to pay 100,000, how much is that promise worth? 100,000. Because it's a promise of paying, unless the government has gone bust and can't pay, that promise is worth, then it's worth face value. So all this is doing is sort of holding your breath for 3 years, hoping nothing goes wrong along the way. Any other questions or comments or thoughts about this arrangement? But in any case, so the bottom line is that when the Fed raises rates to fight the inflation, there is this risk that that act could cause a banking crisis. Now, how would a banking crisis show up here? Banking crisis would be a collapse in aggregate demand. Would that successfully deal with the inflation? I guess, but we don't want a banking crisis, right? That's a new disaster. So one reason why they may not be raising the interest rates high enough is because they're afraid that if they do, they'll bring back 2008, and then we'll be back where we started. Let's see, what can I add to this? Well, I guess the obvious summary of this whole thing is that when there is when there are supply shocks, the Fed can't do anything without making something else worse. And so the conclusion most macroeconomists that I know draw from a discussion like this one is that means that as soon as the supply shock starts to appear, the Fed has to act. Because if they don't and things start to spiral out of control, well, the Fed will have to act then, but then whatever action it has to take will be even more severe. And underlining all of this is the risk that anything it does to fight inflation, again, carries the risk of creating a banking crisis, but that just underlines why you need to act soon rather than later. What's going on today? Well, as I think my description of events probably suggested, I feel like they acted too late. What will happen next? Will we have an inflationary spiral or a banking crisis? Or neither? I don't know. But these are interesting times. And I guess one last thing. Professor Samaniego, you were saying that when the Fed raises interest rates, it erodes the balance sheets of banks, which makes them vulnerable to a banking crisis. But you also told us that in the 1970s, that's exactly what Paul Volcker did. He raised the rates significantly above the inflation rate, which meant very high real rates, which caused the Volcker recession and ended the inflation. Where's the banking crisis? Was there a banking crisis in the 80s? There was. It didn't happen for a few years, but a few years later, there was a banking crisis known as the Savings and Loans Association crisis. Have you heard of it? Nope. Because, well, it was the 80s. It's been a long time. But savings and loan associations are basically like small banks, except that they're regulated differently. They were regulated less, to be precise. And so because they're regulated less, they're the segment of the banking system that was most vulnerable to, I guess, anything. And they had invested in some fairly risky bonds, and so this is what happened to them back in the 80s. So the danger now, as I was mentioning, is that banks nowadays hold far, far, far more securities because all the Fed's operations and also the Treasury. Well, what's the US government debt? I think it's total $33 trillion or something. And that's not all just on bank balance sheets, but a lot of it is. So that's a concern for the next few years. And again, if the Fed is taking these measures where it's just sort of lending banks reserves at face and taking off their bonds at face value, that suggests that not all is hunky-dory in the banking system. Any questions, comments, thoughts? Yes?
Sorry, can you just like explain me again, like how does the rise in the real rates change the security again?
So if the rates are higher, then, so one thing is to remember this story that interest rates and bond prices are inversely related. And the reminder of why that is here. Remember, the interest rate is, so interest is defined as the amount I'm paying you in the future minus the amount you're giving me in the present, right? So that difference is the interest. The interest rate is that I scale that per dollar that you lent me in the first place. And this is true of loans, this is true of bonds, this is true of any debt. The key is to notice two things. First, when we're talking about bonds, this P is the price of the bond. So in the example we were saying this is a US government bond. This F is the 100,000 the US government is promising you in the future. The P is what you paid for that promise. And of course, P is going to be smaller because you demand interest. So the first thing is to notice that when we're talking about bonds, this is the bond price. And this F is the face value. So the government has a contract that says, I promise you next year 100,000, you buy that promise for less. And the difference is what determines the interest. Now I'm just going to rewrite this equation as so, right? I can distribute this 1 over P across these two terms. But then what's P divided by P? 1. So you can see that the interest rate going up in this example is the same thing as the bond price going down. That's the problem. And if the bond price is going down, then that's, as we were discussing, eroding the value of any securities that anyone is holding, I guess, but particularly banks are the ones that are holding large amounts of bonds. And if that happens enough, if the interest rates go up high enough, and if the banks are sufficiently exposed to the bond market, that means potential insolvency. That's the concern. Yeah. So how does it relate to aggregate demand? Well, if there is a banking crisis, then our ability to obtain credit will dry up and demand curve will move to the left, which again is what the Fed wanted to achieve in the first place, but you don't want to do that at the cost of a banking crisis. Right? Any other questions, comments, or thoughts? If not, then it's time for our exit quiz. These classes are getting more and more cheerful. First question, true or false? With supply shocks, the self-correcting mechanism works as well as usual. Of course, that's false. Things can spiral out of control. Next. When supply chains break, we should see which combination of inflation and unemployment. course, we should expect high inflation and high unemployment. Next, true or false? When there are supply shocks, the Fed has an easy job. That one was easy. Next, suppose there is stagflation. If the Fed raises interest rates, then what happens to inflation and unemployment? Of course, if the Fed raises rates, they are increasing unemployment and fighting the inflation. Suppose there's stagflation. What happens if the Fed lowers interest rates to inflation and unemployment? The opposites. Inflation rises and the unemployment falls. This is a poll, so I just want to know your opinion. When there is stagflation, what should the Fed do you think? Based on what you know, based on what we discussed, based on what you've read. Let's see. Most of you think they should fight the inflation. Interesting. Last question. Who is the only person who has who has a recession named after him? Of course, the answer is Paul Volcker. All right, let's see how we did. Third is Caitlin. Second is Rodrigo. And first is Thomas. All right, good job, everyone. Thomas, I have a little something for you if you want. Everyone else, look forward to seeing you next week. And don't forget, I have extra office hours on Friday. See you.